The broadcast is now starting. All attendees are in listen-only mode.
How are you guys doing? You get the sound is okay? Everything good? Or maybe not? No sound? All right, that's two goods. Thank you, Rocky. So Mark is going to be here in a few minutes, so I'm going to get things going just to get started. He's promising a 5-minute arrival time. All right, so first off, a couple things. Live all going in and out again. So my name is Andrew Giovinazzi. I'm the Chief Operating Officer of OptionPit.com. I was a floor trader for 15 years, the last 5 of which I had my own trading firm. I stopped floor trading in 2006, started in 1991. For the last 6 years, I've been with Market Option Pit. The last 2 at Option Pit, we've started 2 funds, Carmen Line Volatility Fund and the Carmen Line Broad Cap Equity Fund, which is like S&P 500 fund with a volatility kicker in it. I manage risk for both those funds. As in addition to working with clients at Option Pit, teaching them how to trade options. I'm here. I'll be on for part of this. Mark will be on for part of this webinar. Also, just to let you know at the end, what's all the good stuff here? There, we just did everything very fast. And so this is kind of the offering at the end of the course. It's 4 more days of learning how to trade the VXX. That's something we trade in our fund. We trade every day. Mostly the thing with the VXX is there's just a lot of secrets and weirdness to it. Also on how it performs at different times. So what we teach is how it works. What are the best times to trade it? All of the things that make it worth trading. Also some of the strangeness with some of the volatility products. So one thing I see a lot of too as well is in a lot of the chat rooms, kind of, sort of the free and open chat rooms, most people just do not understand how the product works. What makes it tick, what makes it run, any of those things. So we're going to discuss a good intro to that tonight. What really makes VXX tick? Kind of from the base to the top, what makes the product work? And I think most of it is just people don't know how it works. It is a good offer for us on the VXX Made Easy series. Plus, you'll get VIX Made Easy and an intro to my Vol newsletter, which is doing really well, which trades the Vol products every week. It has what I'll call maybe a day trade, depending on the conditions. But I look for at least 1 or 2 good trades a week, which are more 2 to 3 week type trades that are manageable for people that have day jobs. Although we've had a lot of volatility lately, so you have to have a lot of orders into the market to close things, especially when they're going our way. But overall, it's gone very well. I got the track record. I've been running it since October, but really for public consumption outside of Option Pit. We started, I think, February 12th, right when all the vol blew up. So we have 14. Actually, we just put on our 15th trade today. So of the 14 trades, 3 lost, 11 is won, and 1 is still happening. So it's pretty decent track record considering the vol that we've had, I think. Clients seem to like it so far. So you get to try it. and actually learn how to trade volatility as a separate asset class. Also for our webinar, do not forget, this is for educational purposes only. Anything you do is yours alone. You have any questions about taxes or investing, don't forget to consult your financial advisor. We are just here to educate you. All right. So before we start, do you have any questions in general about Option Pit? Anything you want to ask before the class? If this is your first webinar here, will it be posted? Yes, it will be posted. Yes, you will get a link. Yes, you will get the slide deck. We take questions during the webinar. Where is volatility going tomorrow? As of right now, it doesn't look like it's going up. Oh, you mean we will when we have to create the link first, Mike? If that's what you mean by enrollment link, it will be posted. It will be emailed out to everybody. The enrollment link for VXX Made Easy. Here, I can do that now. Here we go. That's just an example of the volatility newsletter and the write-ups, how they come out. Let me get VXX Made Easy for you, though, here. I can take control of my screen. And here is the link for VXX Made Easy. It is here, and I will put it in here. There you go. Hopefully, you guys see that link. Considering some of the dough I've seen people lose in these all these other chat rooms with the vol products, and really just not understanding how they work, it's pretty inexpensive. It's a pretty inexpensive lesson. Because, like I said, most of trading options is just understanding how it works. Most of Option Pit is taking market maker techniques. So to explain kind of what we do, it's a little different than other firms. Because Mark and I were floor traders, you basically learn how to just eat everybody's stuff, right? You had to take the other side. You had to hedge positions. You had to manage volatility in a huge way, because you always kind of had to be operational every day. So when Mark started this business about a year before I joined him, I was looking at what he's doing. Like, oh, that's pretty interesting. That looks a lot like you're kind of creating sort of floor trader techniques for our retail audiences. So what we have done is created risk control ways to trade options, to trade volatility, trade calls, puts, all that kind of stuff. But also, we don't forget the risk control hat that you needed to wear as a liquidity provider. So it's one thing to look at a trade like, I just want to do that, but it's another really, too, you also have to understand about managing the risk of the position, just sized for the capital that you have properly. So that's a lot of what we do at Option Pit. So we do not sell we don't sell naked options. We don't do it. You can do it, but that's not what we do. Spreads are okay. Trading in flies. What option structures will be taught? Today in this class, there won't be a lot of option structures in this one. It's kind of an intro class, so it's not really an option structure. For the VXX Made Easy series, it will be time spreads, long gamma positions, vertical spreads. This first class, though, is going to teach you how VXX works. Nancy, so this is basically an ad at 9 p.m. You can yell at Mark about the time if you don't like it. But you will understand what makes VXX move after tonight. Oh, the content for VXX Made Easy tonight? If the content is worthwhile. No, the content will be when Mark gets here. I'm just waiting for him. Sorry, Nancy, he's a little late.
I'm here.
There he is.
I'm here.
Otherwise, I want to go back working on my legal case. You just made it because we have somebody that's touchy already.
No, I'm sorry. My kid had a baseball game tonight, and it ran a little long. And they won 10-1. At least there's that. Mark hit a double and struck out and had 2 strikeouts and fielded a good clean ball. So it was good.
All right. Well, here we are. We just started. Give everybody kind of an overview. Here we are. I did all the intro, disclaimers, gave them a little idea about what Option Fit's about.
Great.
And
well, you just start. I'll chime in as we begin, but I want to welcome everybody to VXX Made Easy. What is the VXX? I want to remind everybody this is for education purposes only. Shouldn't be considered investment advice. Options have risk. You want to keep scrolling forward, Andrew?
Sure.
All right. So here's what we're going to cover today. What is volatility? We're going to talk about, and Andrew's going to do this. We're going to talk about January 16th and how maybe what started happening around January 16th could have told us a lot about what was about to happen. Then we're going to dig into what is the VXX, what makes the VXX move, and how to trade the VXX profitably. Should be a great discussion. Andrew?
Next slide.
What is volatility? Is it the crazy guy from The Taxi Driver? Well, he certainly has a volatile personality. Is it a tidal wave? Well, that's certainly volatile and scary. Is it a storm? You could make an argument that a storm is extremely volatile. It's certainly volatile weather. Volatility is movement. It is a measure of movement. And that's really all it comes down to is movement. And that is what we're here to discuss is movement. How movement affects everything we do.
Should I pop another screen?
Yes. When you hear me pause, that typically means stop.
Did you say why sometimes waves are big and sometimes they're small?
Yeah, I did not, but sometimes they are. Sometimes waves are relaxed and everything feels great. Sometimes they're extremely violent. So, as I said, volatility is simply the measure of an underlying movement or lack of movement. For stocks, ETFs, indexes, and futures, we can measure. There's a lot of different ways to measure it. But the most common is to measure changes from one close to another, sometimes called GARCH. And it's an easy way of measuring how much things are moving. Do we lose some of the intraday volatility? Yes. But do we get a really good idea of what is happening? Yeah. And when we look back over a large period of time, we call that historical volatility. And when we look back over maybe a shorter period of time, we'll call that realized volatility. And we'll have a brief discussion about both. All right, so, where does the Black-Scholes model come? Where does implied volatility come from? So implied volatility is what the market is guessing volatility will be going forward. So we just talked about historical volatility. That is kind of what's happened in the past. Implied volatility is what is in the future. And Andrew, you've made this sweet little chart. Why don't you talk to people about what they're looking at?
So the first thing you have to think about where implied volatility comes from is who's making the decision on what an option costs. So you guys that are all sitting in the room, who's making that decision? Right? Is it the liquidity providers? Is it paper? Who is it? Or is that Randolph or Mortimer? I can't remember which Duke it is.
That's Randolph.
Okay, it's Randolph.
I believe so.
It is paper. Customers are on the phone, right? Or nowadays they just put their order in electronically, but they're deciding what the option price is. They want to buy them. They want to sell them. They're deciding the price. So the stuff you see on the screen is just the liquidity provider creating a balance. That's all. Now, the thing is that we all want to know is the guy on the phone, you're trying to translate that into a usable number. The fact that what do liquidity providers or floor traders do? Did Mark and I ever talk about price with an option? No. All we cared about was what volatility it was.
Correct.
So what you have to do is, for us as a retail audience, now we're a retail audience, even though we run a fund and we're professional from that side, we're still taking liquidity. We're not providing it, although sometimes we do provide it at this point. As soon as an option trades, you want to price it. And that's what Black-Scholes helps us do. It helps you stamp a price on an option. So if an option in Amazon is trading $4.75, you want to know what that means. If an option in the SPX is trading $4.75, you want to know what that means. And that meaning is defined for us as implied volatility. You take the price of the option, because normally Black-Scholes works where you just feed it a bunch of inputs and it spits out an option price, right? So everything you see on the option screen, it's generated from a Black-Scholes model or a modified Black-Scholes or one of many models. What we want to see with implied volatility is to back out that number. So the option price goes in, let's say in the SPX, like in tomorrow in VIX, we're going to see a lot of option prices move around because they're going to create that open auction to generate the opening price for VIX. So what happens is all the prices go in and out pops the implied volatility. All that's doing is it's telling us, if you go back on the slide before, what exactly is that level of movement. We're putting a direct number on the level of movement. And that's the option screen you see on below, the implied volatilities.
Which we're going to look at in more detail on the next slide so that you can actually see what we're talking about.
Yes, just like this one. How did Mark know that?
It's amazing. It's like I've actually looked at these slides before.
So what you have is all these option prices. And why does this matter for VXX? And you're going to find out in a minute. The fact that all these option prices are something matter a lot to all the vol products, right? What you'll learn is they're part of a chain. So when you're trading a volatility product, when you're trading anything really, the implied volatility right here, you see this column? I think I could use that pointer thingy, right? If I do this little pen, right, you see this column right here? Okay, that's telling you what the implied volatility is at any given point in time on any given day. So what this is doing is this is providing a frame of reference for you as an option trader. So
it's the market telling you, it's what the market's best guess is for how much the underlying is going to move between now and June 15th when this SPX option expires.
And you're putting a vol price on that.
Yeah.
That vol price is actually a number and a direction.
Yeah. And that implied vol, which we're going to discuss a little bit, actually doesn't come from a model. It comes from the pricing.
Right. It comes from you putting orders in.
Just like a stock price is really where buyers and sellers meet. Implied volatility is really where buyers and sellers meet at any given time.
Okay. So, say you want to talk a little bit about historical volatility?
Yes. This is historical volatility. The white line is what's happened in the last 10 days. So backward looking over the previous 10 days.
So here's a test for everybody. What happened today? Did volatility go up or down? Just a quick test. I was just seeing if anybody was listening. Are they typing? Up. Thank you, Rocky. All right, we have some ups. That's good. Sorry, Mark.
Yeah, it went up. And then if you look at, and so that we'll use this white line as kind of our best measure of realized volatility, kind of what's happening right now. And then the grayish line is 30-day historical volatility. And that is what has happened over the last 30 trading days. And that's more a good measure of kind of historical volatility, where volatility has been in the near term and is much more smooth than 10-day. You can see 10-day has these huge spikes, and you know, the 30-day doesn't have quite the same spike. Someone said price drops, volatility increase. Not necessarily. We're going to talk about that a little bit, aren't we, Andrew? Thank you for the setup, Bill.
Bill, I thank you.
Well, you can fade the spikes unless the first spike is the fake spike. TJ Pac-Man.
I think that's part of what we teach in the class, but also what you're going to see here.
Next.
Okay.
Here is the VIX. So, Andrew, why don't you kind of get into this?
So the thing is, where does the VIX come from? The VIX comes from the implied volatility in the SPX. So around 30 days out, I took this slide. So I just want you to imagine, right? Every term here, the whole reason for this slide is the fact that the SPX has each term, each weekly option in the SPX has a different volatility, right? And it has a different volatility for its place in time. So the VIX, what we're going to see here in a second, is VIX is for 30 days out. So VIX is not necessarily pricing volatility that's happening today. It's pricing the perception of volatility in 30 days. Okay? And what you'll see is, why is VIX important to VXX? But the important thing to remember is the SPX has volatility. Okay? Right now, actually, this snap is kind of cool because I think this is the lowest snapped vol picture for the term structure in SPX for last year. Every volatility was in the 7 handle, which is we haven't seen in a while. We haven't seen it since.
Yes, and we may not see it for the next 10 years.
Right. Now, what's funny is, at this time, VIX was trading 2,500. So I believe we're trading at a higher level of SPX. But
yes.
But VIX then was actually cheaper. So the thing is where volatility is relative to the underlying is an important thing. So what Bill was just saying, price drops and vol increases, that's a general trend, but there's some wrinkles in it that you're going to learn. Okay?
Indeed.
What does VIX actually measure? So everybody's saying, well, the whole thing is about VXX. Why don't you talk about VXX? Well, you can't talk about VXX until you at least understand where
VIX is. You have to. Everybody learns to ride a bike before they learn to drive a car, and VIX is the bike to the car. It's the mechanics it's the engine mechanics of the VXX, if you will.
I like that.
The engine.
It's almost like this session is being recorded. Oh, thank gosh! For a second there, this new GoToMeeting, they keep changing the recording thing on it. It's like, oh my gosh, if they'd ever just keep it the same. So what do we have? Why 30 days? Well, when they invented VIX, all they had was 30-day options. They have since, still a 30-day option, but they do use the weeklies that are relatively close to 30 days. So the actual term, remember a picture I showed you before, the slide of the term structure. VIX is actually, they're setting you somewhere between 23 and 37 days out. So we're just off the right side of what this would be at the time. Okay, so it's looking at a narrow slice of the market. It's not looking at the whole market. It's looking at a narrow slice of the SPX. That's why the calendar is so important to trading VIX, because what you're doing is you're looking at what's happening in the future. So how the market is pricing what's happening right now could be very different 2 days from now, especially when you put it through the lens of 30 days. Okay? So the most important thing, I think, to remember, too, is VIX doesn't measure the IV of options expiring this week or next week in the SPX.
No, it's looking at a month out.
Okay, not directly. So the fact that the market moved a ton today, or not a ton, I mean, a month ago, this would have just been a normal move. But
it would have been a blip.
It moved a lot relative to kind of what it's been doing lately. So VIX picks up. VIX will take that number and just sort of run it through a lens, a 30-day lens, and tend to damp that movement down a little bit. But still, the idea is VIX is looking at implied volatility from the SPX that Mortimer himself sets the price. Why does he set the price? Because paper is setting the price of the options. Would the option market be possible without the VIX? Absolutely. Absolutely. Is it correct that we cannot trade calendar spreads in VIX, but we can trade them in VXX and other VIX-derived
You can,
ETFs?
but they're different. We'll talk. That's a totally different discussion. You can trade them, but they're very different than normal calendar spreads.
There also, too, is they're dangerous. A VIX calendar works the opposite of a normal calendar.
Trading VIX calendars is a lot more like trading corn or soy calendars than it is like trading equity calendars.
Right. The front month can blow up in your face, Mike.
Right, which can happen in corn or soy. It can't, or cattle. It doesn't really happen in equities.
If that helps. Plus the margin's going to be really high. Okay. So how do the VIX futures? So now we went from VIX cash to a VIX future. And now everybody's like, okay, well, we talked about Randolph setting the price of options, creates some volatility in the SPX. The VIX grabs that volatility, creates an index, and now you have how the futures price that cash index. Right? Layers. 1, 2, 3, 4 layers now. So the method that we have that we talk about in VXX Made Easy is how do you gauge the accuracy of those futures? Right? What's going to make that VIX future move when the cash is at a certain point? So the rule that I have trading the vol products is the gravity rules, meaning in general, this future is going to fall to this cash level. Right? So think about when you trade futures in general, as every day goes by, what happens to the premium between the future and the cash? Right? So if you're trading a contract, if you trade this future, or even if you trade an option, what happens every day as time goes by? What happens to this future premium? Right? It erodes. So from a trading point of view, you want to know which direction this erosion is going and how fast it is. Because in order for VXX to move, this erosion has to act a very certain way. Right? These futures have to act a very certain way to get VXX to move a certain way. And what you learn in VXX Made Easy is it's gravity that makes it work. And your job is just to figure out how much that is and actually learn how to price and trade it. Okay? It's not a trivial thing, but it's something that you can learn. Does that sound right, Mark?
It does. It sounds perfect.
VIX and futures are equal at expiration. The VIX and the future are equal only at settlement on Wednesday morning, Bill. Only equal now, one Tuesday time in their whole lifetime.
Tuesday night they may correlate heavily, but
90% or so.
Yeah, but and really the expiration VIX isn't even the actual VIX, because you'll see, like last month, expiration was crazy. So there is a settlement procedure where a VIX converges with the future, but it's not the VIX. But that's getting into the weeds. So keep going, Andrew.
Right. So, and this at the time I was running my vol newsletter. We hadn't launched it yet. It was in Option Pit. But something we teach at Option Pit is something called conditional awareness, which means what's going on with the volatility. Is it where it's supposed to be for what's happening? So, SPX and VXX on Jan 2018. This is Jan 16th, 2018. This is the day before VIX expiration, I believe, or the day of. It was the day before because I was trying to remember exactly which. It is the day before. So I'm snapping a picture. So I'm snapping a picture of what was going on in January, right? So, and do you notice the danger, Will Robinson, is for volatility traders or people that are interested in following vol for a signal, anytime it's doing something it's not supposed to, we care.
And again, he could have used the one from the new Lost in Space, but no, not even the one from the crappy movie. He decided to use the one with the black and white weird kid and the creepy guy that probably touches boys.
Well, I'm old, so I remember this one. Do you guys remember that robot, by the way? All right, anyway.
Yeah.
So what's happening? Okay, here's SPX, and now we're talking about VXX. We haven't said anything about VXX except it's this thing, right? We haven't described it hugely yet, but I just want you to look at how the two products are moving, right?
Yeah, and I think the key is look at the big run up in the S&P,
which is
right. Andrew, point that out.
Oh, hold on, let me.
Big run up in the SPX.
I'm going to do the highlighter for this. Here's the big run up.
And then look at what happens in VXX, right? Remember at the top of the show, somebody said, well, market up, SPX, vol up or vol down, right?
Look at the volatility in SPX into the run up.
Yeah, and then look at VXX into the run up. At first, it starts to drop a little bit. Then what happens? It starts to go higher.
It starts to go higher, but it's not going down anymore.
Yeah, that's weird, right? You've got the S&P hitting all-time highs, and VXX isn't going down in January. It's very quizzical what was happening, and everybody was raising their eyes to this. What is going on?
Okay.
What is going on?
Volatility in the implied volatility in VXX also. That's the vol of the options going up. So you had something really, really, really odd going on.
So when everything was going up, when only one thing should have been going up and the other three going down. Four things going up. Normally, who remembers?
Have 1, 2, 3 going down. The SPX.
Yeah. So do you guys remember Sesame Street? It's still on actually, but there used to be this thing where there'd be like 3 kids doing jump rope and 1 kid playing basketball, and there was a song that would be like, "One of these things is not like the other. One of these things just isn't the same." Does that ring a bell?
It does to me.
Yeah, one of these things is not like the other. Can you tell me by the end of this song? And so normally what you should see is the SPX going up should be the one that's not like the other. But instead, everything's the same. That's bad. That is the market saying, uh-oh. And I can remember I was emailing, I'm going to name drop here. I do a bunch of VIX analysis for TheStreet.com and Jim Cramer. And I was emailing Jim Cramer back and forth, saying, hey, there's something really wrong. And then I was proven right.
Oh, that's right. You were.
Because look what happens.
Right. So
everything keeps correlating for a while.
Right. And then it blows up. And then you had this kind of...
Everything blows up, right? You had vol up. Everything went back to normal, right? The SPX is down. And the other 3 are all up. So we're back to our one of these things is not like the other.
Right. They're all doing what they're supposed to do now.
Yeah.
So the gist of this is, so in our Vol newsletter, if you're an Option Fit member, what were we doing when we had this going on in the SPX, right? We were buying Vol in our strategy letter because when things don't look right, you buy Vol. We were actually financing VXX strangles at the time because you'd buy them and then VXX would keep going up and we'd keep unwinding part of the position and it ended up working out fine. So at least into the run-up, we were not actively selling vol in our newsletter because, at least from my strategy point of view, it was just telling me not to, because everything pricing-wise that I use as a metric was basically all whacked out. Okay. Now I get more technical in our VXX Made Easy class because I give you hard numbers to look at, but it's a conditional thing. Okay. Let me see here. Let's go to erase my drawings. And I got to get the right pointer. And here we go. All right. So, okay. So here's the thing. This is probably one of the key things too. And this is the thing. I think she's like, oh, we're going to learn anything. I go, the most important thing and the biggest tell and the least understood trade information, I guess, indicator out there is the shape of the VIX curve, which you'll learn how to trade, and its relationship to the VIX cash at any point in time, right? And we actually have ways to quantify that, let you know what it should be worth, how it should be trading, and the ideal type of trade at that time. Right? That's all our vol strategy letter does. All we do is put on what the ideal trade is that has the most edge, and then you let the market play. Little different idea than probably almost anybody else trading volatility. Why did they invent the VIX if it is possible to do without it? TJ, you're going to have to ask the SIBO, because they just wanted a volatility index, just like they wanted an index for volatility.
I think it's really useful. I love the VIX.
Yeah. It's possible to do without almost anything. If we could do without stock options, right? Don't need
do
them.
Without beer. Why'd they invent beer? We can do without beer.
But
wine.
But it doesn't mean it's not fun and useful. But
yes. But doesn't mean it doesn't serve a purpose. Just because it's not 100% needed doesn't mean it doesn't serve a purpose. Before the VIX traded. It just traded over the counter.
Maybe
it didn't trade listed. It traded already.
Right. And people quoted implied volatility, TJ. So the thing is, as a liquidity provider, things were quoted to us that you don't see as a retail trader, but they would quote stuff tied to volatility and tried to trade, and tied to volatility, not necessarily tied to option prices all the time. So an institution would quote stuff in volatility, which is not exactly retail, just says they seize quarter half and they take the trade, right? I think it helps. It doesn't help market makers because we always knew where the vol was because we priced it. I think it helps institutions identify volatility. To answer your question, right? And it's become the biggest trading product next to the SPX, and sometimes bigger than the SPX. So it is helpful. So this is the key thing to learning how to trade the VXX is what you want to learn. So for all of you that are sitting here that sat in on the video, this is the slide you want to understand. Like, what's the big difference about this slide? Right? Oh yeah, does the flattening of the VIX futures structure help to forecast a possible market correction? Yes, it does, Virginia.
Read the book.
Yep.
Yep.
So at the time, there's actually two things. It's flattening of the curve and the position of the curve relative to where the cash is and how much premium there is in here. So there's actually I draw a lot of pictures. Well, the VIX is totally helpful. So here's another thing, too, if you think about it, Virginia.
Hey,
what?
You're going to learn all about how the VIX can be helpful when you take as we
in our
dig in.
course. But what I want you to get from this course is look where the 30-day future was relative to the VIX cash on the close on the 16th. This is really the last expiration before everything just started to take off. Okay, the VIX cash was 34 plus 7.5 is 41.5 cents over parity. It was very, very close. Normally that premium is much higher, somewhere like $2. So there was an inherent dislocation in the market at the time, right? Because there were forces selling futures, and I can give you can get an idea of what vol products were actively crushing the futures because they don't exist anymore relative to where the cash was. So by learning how to read the future and the cash, you're going to gain a lot of insight into what's going on. Okay? Okay, I have a question. Is this webinar about futures or options referencing VIX? This webinar is about what moves the VXX.
About VXX, but we're setting that up.
Finish. Okay?
We'll get there. Keep going, Andrew.
There we go. So, before the January 16th breakdown, VIX cash got way too close to the longer term futures for too long. Right? Again, this is my opinion, Mark's opinion. The rising SPX wasn't in sync, and the IV kept increasing. All of this is signals, bad signals for the market going forward. And also,
VXX was rallying.
right. Okay. So VIX was in contango, but very light. Okay. So all these are signs for a higher realized vol. Okay. So what happened was all these things were kind of flashing danger and higher realized volatility, which is what we had. Now, could anybody have predicted that would have lasted that long? No.
That's the problem. It can, what that can tell you is, hey, it's time to start thinking about hedging.
This
we'll
VIX.
We'll keep going.
Okay. So now, what's going on with the SPX now? Okay. We have, again, here's our term structure. We're out to June. This is about a month out. Okay. And I have around a 10.5 volatility here, and the 30-day volatility got down to 10.5, and this was Monday. This is basically the low tick of volatility on Monday when I redid this slide. Okay. This 30-day volatility using live vols calculation was translating into about a 12.5 fix at the time. So again, we had new volatilities. Notice that all the volatilities of the terms are different. Right? Remember I showed you a slide where they're all in the 7s when it was ultra low. Here the volatility was about 3 points higher than that. Okay. The SPX IV usually undershoots VIX. So the answer to that question is yes, because
according to their calculation,
according to live vols calculation, because
live vol doesn't use as much skew as VIX does, so it's not exactly the same. It's orange juice and oranges.
The live vol calculation uses only 7 strikes, and VIX uses like what, 500 strikes or something like that. VIX uses every strike with a bid, and live vol only uses 7 strikes, right around the money. So it will always be lower. Another question is calendar spreads in VXX are potentially hazardous. Not VXX.
Not in the same way VIX is.
VIX is. They're different products.
Keep going. We'll get there, folks.
Now, here you go. So we had to put some backdrop into this so you can understand. The first thing to remember about the vol ETPs is what they are, right? Your options on an ETP or an ETN that are priced from VIX futures, which are priced from the VIX index, from option volatility on a cash index that try to predict forward volatility. 1, 2, 3, 4. Oh my gosh, you see that guy in the right? So trading these products, the best way to trade the products...
a picture of Andrew trying to manage risk for me when I'm trading.
Maybe in February. It's easier now. So here's trail of the VIX, right? So to understand how a VIX ETP or an ETN trades, right, somewhere over here, you're following all the things that go into it, right? The VIX index provides a trade to the VIX futures, right? Also, those VIX options price off of VIX futures. The VIX ETPs price off the VIX futures, and then the options trade off of those. So when we construct option trades for VXX, look at what we're doing. We're teaching you how to actually look at it the right way by working backwards. Okay? Because just because you think VIX is going up or VXX is going up doesn't mean it necessarily is if something in the chain is broken. Do you guys understand that? Now you're like, well, how does that work? But that's what we try to teach you about. A derivative of a derivative of a derivative. Something like that, TJS. But once you understand how the relationships work, it's a lot easier. If you're just trading it by gut all the time, it's pretty hard. If you think that, you know, and the performance of those products over time are awful, like VXX, it goes down. Right? Because what does it do? It buys futures. But you have to understand it this way. If you understand it this way, it'll work better. And let me go to here. All right. So, what is this thing? Okay. Here is a history of the product. Okay. Notice one thing about the product here. VXX was kind of going down. This is at the beginning, the end of 2017, right? Really going down, crapping out, okay? Then kind of stopping, right? This is about where we showed you on the 16th when things really stopped. Then all of a sudden we had the vol apocalypse, where the nature of the product went from about 30 to 57. It's something that Mark and I say in our room all the time. You have to be careful with these vol products because right now they look like this VXX can never go up, but that can change in a heartbeat. So all the trading you do, right, you have to be mindful of that. Then we had the volatility, crazy vol, and it kind of bopped back and forth. And now things are kind of getting a little bit what I would say, quote unquote, normal for VXX. Right, there's more normal trends going on, what we call like a contango trend as opposed to the backward trends we've had. Oh, Steve said sound. Anybody else having a problem with sound? Hopefully not. Okay, so the idea is the trades that work here are different than the trade setups that work here. Okay, the trade setups that work here in backwardation are different than the trade setups that work here in extreme backwardation. Right? All different for how you trade VXX options. Right? For every condition, there's a different flavor of trade.
Learn to trade for what's in front of you.
Exactly.
So keep going.
Okay. The ETNs can create new shares out of the blue, but VXX has a good history of that, TJ. They don't create more to create a crash. Like TVIX is an awful product because they actually issue more shares than they have the ability to back, and then the product crashes. So here's some information about VXX. So what does it do? It buys futures and holds them as an asset in the ETN. Okay? Or it tracks the index that buys the futures. Okay?
It owns futures that have, I mean, it makes sense, right? VX is a constant 30 days to expire. So VXX holds a future with a constant duration of 30 days to expiration.
Right?
Right, makes sense. Why wouldn't you want that?
That's what the product does. Okay? It doesn't buy VIX cash. Okay? That's why in red, when I put something red on a slide, you should understand it. So if you're going to trade VXX, which is what this webinar is about, amazingly enough.
And if you're wondering what VIX cash is, that is simply the VIX.
That's just the VIX index. Right. Barclays has not changed the rules with VXX, and so far it has been a reliable product. So that's, again, another thing you learn with the Vol newsletter, everything like that. Everything you have to size properly. You can't go all in on these products, anything. Or you could be really unhappy, or you could be really right, but that's not the exact risk profile we want people to take. There's a link to the prospectus for VXX. It's 200 pages. Most of it's boilerplate, but a lot of it actually describes
There's some
what
details
goes on
in there you need to know.
Okay. What happens, though, with VXX in general is it slowly goes out of business. It will end as a note in Jan of 2019, and VXXB will take its place and basically act just like VXX did.
And it will be called VXX eventually.
Okay. Should you put that in the chat box? You want this prospectus, Nancy? Just for you.
What a nice guy. I would have told her pound sand. I'm kidding.
Did that work? Oh, hold on here. I tried to. Yep, it's in there. Okay, it's in there. Everybody should see it. Hold on here. I got to get back to where I was. All right, good. She will send Robbie Robot after you. All right, so if you're not following along exactly, of course, that's what the course is. But these are things that VXX buys futures. I just showed you the trail, right, of that vol future, right? That vol future goes all the way through here. To trade this option over here, moves all the way through this thing. Okay. Now, here's an idea. This was snapped last week, right, on the 8th, where VXX was holding about 70.7, almost 71% of its position was the June, and 30% or 29% of its position was the May. Okay. So what happens is every day that rolls and changes that future. Okay. So what happens with these futures is not only is VXX holding futures, but the amount of futures it holds, like Mark said, changes every day. So VXX actually moves differently at different parts of the month. So not only to confuse the issue, if after this webinar you're like, this product is so confusing I don't want to trade it, but the thing what makes it interesting is the way it moves, it acts the same way every month, right? All these patterns are the same. Sometimes it's going to move, like that's one of the reasons VXX moved a lot today, I think, is just because it was all June, right? It's just one future. That future moved up a buck and change. The May was dead. And there was actually a lot of potential underlying movement for VXX for this week, actually, because it's all June.
Yep.
Okay. VXX has come down, but not VXX. Is VXX too high or VIX too low? I think, John, that's a different question because the fact that
we're gonna kind of discuss that. The two are related but not tied.
Right.
VXX and VIX are first cousins. They're not twins.
Right. So if I said, does VXX price off the VIX futures or the VIX cash? What should your answer be, John? Right. It is only peripherally linked to the cash, but it doesn't trade off the cash. That's why you have to understand the future movement, which is what this webinar is about.
It's VIX's first cousin.
I like that. They're kind of like kissing cousins, but not exactly.
The VIX futures are like a half brother.
Or like the Kardashians, maybe.
Yeah, there you go.
Okay.
They're like Kendall Jenner.
What kind of option trades can you do with this product? Please give me some examples. All
Keep
kinds.
going, Andrew. We'll get there.
January 2016 market was a great signal, right? If you use our method, you'll learn how to estimate the value for the futures, the best predictive path for VIX moving VXX, the best times to trade VXX, the best long and short trades. Those are the kind of option trades you want. That best leverage being long and short, and lessons in UVXY and SVXY, which are cousin products. So I can't give you a position, Nancy, until you tell me the condition, which would take about 4 courses to do, which is why I set the course up. Because if I just threw darts at you, then it wouldn't do any good. Does that make sense? Because you want to know why they do things. So if I told you buying a strangle in VXX was a great trade today, but normally it's not a great trade. They are long calls, long puts, long strangles, long call spreads, long time spreads.
There's all sorts of ways to do it.
Yeah. It's just, again, you're not understanding. It's a conditional trade.
It is dangerous to trade VXX options if you don't know what you're doing. That is correct. All right.
Okay. But what we do, though, is almost everything I do is from the long side of the options.
All right.
How are we going to learn that in 4 hours? Have you ever taken a course from me, Nancy?
Keep going, Andrew. I'll talk about it.
Well, after you do, then you'll understand why. You'll understand in 4 hours. If you don't, I'll just refund your money.
And it'll really be 6 because I know how Andrew operates.
It'll be more like 6. Famous last word. She's dissing us.
I know. Keep going, Andrew. This is being recorded.
Here we go. So, understanding the volatility that drives VXX is one part of the puzzle, right? So, if you want to trade VXX options successfully, you have to understand how VIX works, the cash and the futures and the relationship, the implied volatility in VXX, contango and backwardation, what that is, and how you actually define edge in the VIX futures and options. So all that stuff we define. And then once you have a definition of what edge is, that sets up a trade.
Yes.
It's like step A, step B, step C.
One of the things that we're going to be one of the things you're going to learn is that there's a mathematical formula to figuring out VXX. And if you can figure out that mathematical formula, which we do and know and can teach you, and we'll show you, you can trade VXX successfully over the long haul.
How long roughly do the trades last, and do you use special software?
We'll get to that at the end.
Okay. Okay. Oh, wow. It's already 9 o'clock, 10 o'clock.
Yeah.
That went fast. Here you go.
Right, so we are going to teach you how to trade VXX. You don't need software, but you do need mathematical formulas, and we'll give you a spreadsheet that'll help you. And we're going to teach you that there's a ton of opportunity to make money trading VXX and the other VX ETNs. It's a course that is a must for anybody that wants to be an income trader, that wants to produce consistent income, because from my experience, VXX is one of the easier ways to actually be a successful option trader. You just need to understand the math behind driving your trades. So what are we going to teach you? We're going to light the path of VIX to predict VXX moves. So you'll be actually able to predict with some certainty, but not certainty, but you'll be able to mathematically predict over time where VXX is going. All right. So you'll be able to execute VXX trades at absolutely the best times. This is one of the things we can definitely show you, is when is the best time to do the right trade. We're then going to tell you how to be long and short, when to be long and short, and we're going to teach you the VXX cousins, UVXY, and SPXY. And is it easier than SPY options? I think VXX is much easier to make money on than SPY, don't you? Andrew?
VXX, yes.
Yeah. And so if you sign up before the 18th, I'm going to give you 1 month free of the Volatility newsletter, so you get to follow along with Andrew, and he'll teach you what we're doing. And if you sign up at tomorrow, we did a VIX Made Easy course that you'll want to take between now and the beginning of this course, which starts a week from Tuesday. And you will be prepped and already ready to trade VIX when you take this course. The course, all right, so the VIX Made Easy course goes for $297. This course will go for $297, and the Volatility newsletter, the retail on that is $197. So we're talking about a little under $800, and we're going to let you take it for $197. Why? Well, because VIX Made Easy is already in the tank. The Vol newsletter, having an extra eye on it doesn't hurt us, and you're going to want it. And this course is really good, and you should take it. And so we're going to let you do it for $197. You go to optionpitmembers.com/easyvxx. And obviously, if you know a coupon code, you can use it. I'm not going to give those to you. But this is a great product. And there is tons of opportunity for the retail trader that tends not to trade the way a professional volatility trader does to make a lot of money doing really well on this. Obviously, you have to be educated and know what you're doing. And if you go through the course and you say, Mark, this sucked, I will give you your money back. Go to optionpitmembers.com/easyvxx. And like I said, you need to sign up by tomorrow to get the VIX Made Easy series. Any questions?
There you go.
And if you want to see, and here's the best part, if you want to see a replay of this webinar, Andrew, scroll down.
Okay, hold on. There it is.
There it is. There's the one from last week, and we'll have this one posted there tomorrow. So you're going to want it. You're going to love it. And if you hate it, which you won't, it's risk-free. So with that, what questions do you have other than how quickly can I sign up now?
I think that's the right question. How quickly can we sign up now?
This course is being prepped by collectively about 60 years of experience. So we've seen it all.
Can you describe again which structures we will be learning? I could go back to here, right? So how to price the VIX cash and futures, how to use implied volatility to price, how to price contango backwardation, how to price edge, and then put that into a position, Mike. So once you understand how to conditionalize the trade, then we put the position around the trade. Does that make sense? The newsletter, what is it every month, Mark?
List price is $197. If you take the course and you like the newsletter, we'll charge you $97 a month. And if you're trading $500 a trade, you should more than pay for the course easily over time, obviously.
It's a good intro. It's a great intro price, actually. So the deadline is May 16th by midnight Eastern Time. Class P asks.
Yes.
Yes. Nice to have a sample of what?
Well, why don't you show, sure. Andrew, what's your track record look like right now?
Sure.
Pull
I
up
can show you two things, right? So here it is. We've got, whoops, this is not quite right. Right? So the trade, all everything that I've tracked, in, out, all adjustments, everything is followed. Okay, so during the most volatile period in the market history, we have 11 wins and 3 losses. Okay, I have all the pricing. There's still 2 open trades, but they're in a position where we can't lose on them. I just haven't. I'm trying to stretch them to put a little more into them. I started the account size for $100,000 at the beginning, which was too much.
Yeah, the class.
50.
The class. If you look on the course, if you look on the OptionFit members / easy VXX, it says exactly when the course starts.
Right.
It's going to be May 22nd, the 29th, June 5th, and
So
June 19th.
when you see red here, it's a closed trade. Just the
And obviously we record them, and you get to keep them.
Right. And the sample of the newsletter looks like this, right? So when I put out a trade, so here's a trade we put out today, buying VXX 3844 call spreads and buying 4 VXX Juno 136.5 puts on that ratio.
That was a nice trade.
It was a nice trade. Okay. Examples of trades we have kind of time spreads here. I arb volatility versus SPY when the conditions are right for it. We arb VIX versus VXX. You can do everything in your retirement account. Yep. I trade this in my retirement account. So all the trades, by the way, are pairs. Most of them are pairs, not all of them. But we trade just the most liquid stuff, VXX, VIX, and SPY. I will do QQQ every once in a while against VIX when it looks really
Andrew,
really
in addition, Andrew does a weekly gathering where you get to ask questions and you can kind of quiz them about the stuff that's on right at that point.
Right, we post it.
It's kind of a steal.
It's usually about 45 minutes to an hour. Teach you how to trade volatility. So if you don't know what's going on, a lot of our clients right now just monitor the letter and they've been learning. So they paper trade and just kind of learn how to do it. We'll also trade like iron condors against VX or VIX to show you how to position those. It also helps if you're just an iron condor trader because you can learn how to hedge your iron condors. So the short answer is it's just not dumb stuff. Okay.
It's a great class.
Our pro traders have been trading this since October when I launched it.
Yeah.
And they like it.
All right.
There you go.
Yeah. You'll be happy.
The date for the class, we start it next Tuesday, a week from today. It won't be 9 o'clock though. It'll be 7 Eastern time.
Yeah, and again, it's recorded if you can't make it, and you get support from email and all the materials. And if we use a spreadsheet, we'll give it to you.
What time do you hold your question and answer sessions? They're Wednesdays at 5:30 Eastern time, Nancy. And they're all recorded. And you almost have an entire vol tutorial right here in our thing. So I am going to take the videos and put them on a separate page. So even if you don't know how to trade vol even for a month, you'll probably learn a lot just by looking at the archive.
All right. And Andrew, stop the recording.
Yes, sir. The recording is now stopped.